I will always react well to declining prices. If I like to buy a business, if I could buy this hotel we're in and they drop the price, is that good news or bad news for me? I mean, if I like to buy hotels. So, but the fundamental point, and some people get it and some don't, but when you are buying a stock, you're not buying something that wiggles around or is on a chart or has a target price. You're buying part of a business. If you're right about the business, you don't pay a crazy price. You can be right about the stock as long as you don't do dumb things yourself. Set out to buy stock at prices below intrinsic value per share. Now, intrinsic value per share is not something that is precise to the penny or anything. It's probably a band of 10% or something like that. And my partner, Charlie Munger, if you asked us to give you a slip of paper with intrinsic value per share on it, it would not be the same figure, but it'd be close. And we both would have a band or something of the sort. If you're buying it below that figure, if we've each got $1 and you'll sell me, and we put it on the table and you can't reach it for a while, you say, well, I can't reach it, so I'll sell you my share for 95 cents. I'll give you 95 cents. If you say $1 too, so no dice. So it's not complicated. It may be beyond my ability to figure out the intrinsic value of certain kinds of businesses. But with Berkshire, I've got a reasonable idea, and I try to give the shareholders the same information that I regard as important in calculating that. Now, it can change. Presumably, you want it to change upward over time because we retain earnings and we should be building more value. But that's the equation. First of all, you have to have the cash you need to run the business. I mean, Steve Jobs called me one time. I mean, he called me, I don't know how many years ago, and he was thinking about repurchasing shares. And I said, Steve, there's just two questions. I said, A, you have all the money that you need to develop the kind of business that you've got in your head for the next 5 or 10 years. And, he says, we got plenty of money. And then I said, then the second question is your stock selling for less than it's worth? And he said, it's selling for a lot less than it's worth. And I said, well, you've answered your own question. But if he'd answered, we need the money we've got here actually to fully develop our business, and we've got opportunities to do it, I'd say forget about it. Build the new plants and do that, and maybe the cash will come in later where you can buy in stock. And secondly, if he said the stock isn't really cheap, what's the reason for buying it in? When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling form of act. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.